In exactly 5 days, January 8th, a forced selling event is about to hit the silver market. Billions of dollars will be dumped not because fundamentals changed, but because index rules force it. And the banks are counting on you to panic and sell with them. Nate Saint here with Peak Life Wealth, helping you protect your hard-earned money from inflation and build real lasting wealth. Right now, silver is trading around $73 to $74. And if you only look at that number, you're missing the entire story. Because what happened in the last 72 hours, the $17 billion Fed injection we talked about, the 84 tons that vanished from Shanghai, and now today's opening action, these aren't separate events. They're chapters in the same book. And that book is telling us the old system is breaking in real time. But here's what nobody's talking about. Let me show you what actually happened starting January 8th and why the next 5 days could shake out everyone who doesn't understand what's really going on. Starting January 8th through January 14th, something called the Bloomberg Commodity Index rebalancing window opens. This is when massive institutional funds are forced to adjust their positions based on year-end weightings. And here's the problem. Silver had such a massive year in 2025 that these funds are now overweight. They have to sell. Not because they want to, not because fundamentals changed, but because the index rules force them to rebalance. This is mechanical selling. It's algorithmic, and it's coming in the next 5 days. Now combine that with what else is happening. The CME just raised silver futures margins again after the violent swings we saw. Higher margins mean it costs more to hold positions. This forces leveraged traders to either put up more cash or close their positions. Most will close. That's more selling pressure that has nothing to do with actual supply and demand. So here's the trap. Over the next week, you're going to see headlines screaming that silver is crashing. You're going to see red candles. You're going to feel that knot in your stomach. And the banks are counting on you to panic and sell. But here's what they're not telling you. While this paper selling is happening, look at what's going on in the physical market. Dealer premiums didn't drop after the New Year's Eve flush. They're still $10 to $15 over spot for silver eagles. That means the real market, the market where actual metal changes hands, never believed the crash. The physical buyers are still there, waiting at $70 to $70, ready to absorb every ounce the paper market wants to dump. And in Shanghai, the spread is still $3 to $5 above Western prices, even after all the volatility. China's export licensing went into effect January 1st, and it's already working. The flow of metal from east to west has been choked off. According to the latest COMEX data registered inventory, that's the metal actually available for delivery, dropped to 128.16 million ounces. That's down from where we were just days ago. The vaults are still draining while the paper market is trying to convince you there's plenty of supply. This is the disconnect you need to understand. The paper market is about to get hit with forced selling from index rebalancing and margin pressure. But the physical market is screaming shortage. Premiums are high, inventory is low, delivery delays are stretching into February. So what does this mean for you? If you see silver drop to $70 or even $68 next week, don't panic. Understand that it's structure, not fundamentals. It's forced selling from index funds and margin calls, not a change in the actual supply and demand picture. In fact, if the paper price drops while physical premiums stay high, that's your signal that the disconnect is getting worse. And when disconnects get worse, they eventually snap. The paper market has to catch up to physical reality. It always does. The floor is solid at $70. We've tested it twice now, and both times physical buyers stepped in. That's your line in the sand. As long as we hold above $70 through this rebalancing window, we're set up for the next leg higher once the forced selling is done. The target is still 85s. That's where the measured move from this consolidation takes us. And with pension funds starting their January buying, once we get past this rebalancing noise, the path is clear. But here's the uncomfortable truth. This volatility is the price of admission. If you can't handle a $5 swing in a week, you're not positioned correctly. You either need to hold less, or you need to stop watching the screen every 5 minutes. The metal doesn't care about your emotions. It's doing what it needs to do. Go to the link in my bio for the free inflation-proof wealth system guide. This is the guide I wish someone had given me, and I want to help you the same way. I'm watching things closely and will keep you updated as this unfolds. You now know what most people don't. The next update could change everything, so make sure you're here for it. Stay sharp, stay stacked, and I'll see you in the next one.